Hope you all had a good weekend. It's going to be a crazy week. Bloomberg, 5 things you need to know. This is a free publication if you don't have a Bloomberg account. They will email it to you every morning.
As a woman of color, I didn't
So Russia is a part of the SWIFT system. We posted an article on this, and while a sanction against Russian banking had been on the table, it hadn't really been brought forward as a serious sanction until some point over the weekend, and that had a lot to do with the drop we saw Sunday night. We posted articles in it in the large caps chat if you want to read more about it. Energy is still a big deal. So commodities. We have a lot of economic events this week, not just today. And all week there's going to be Fed governors talking incessantly. So really be prepared for that. The president's schedule, I heard on Bloomberg that he was going to be speaking today. I went and checked his schedule. It's not a part of the official schedule yet. The only thing I see on here is the 3 o'clock briefing, but he's supposed to be having a phone call around 11:15. So maybe sometime after that, not sure. But if he's going to be out of town doing this big celebration at 2, then it would have to be before that. So I know, maybe just kind of keep your eye on any official posts of when he's going to be talking. FX Street kind of does a nice review of the dollar this morning about what's going on over there, the kind of moves that we're seeing. It mentions delegations from Russia and the Ukraine are supposed to meet. So, of course, the market's going to like that. If you go to Thinkorswim, go to Market Watch calendar. Yours may be just completely full like this. You want to narrow it down, uncheck everything, and just turn on Econo Day events. I like to grab that description and bring it over next to the time frame so that I can see what time the event is and what the event is. A little easier. The dollar opens at 8. The bonds open at 8:20. And then we have economic events, 8:30, 9:45, 10:30, 11:30, and 3. So as you can see, we got a full house. Not only do we have, the president talking, we got Fed speakers coming on. We've got the whole situation over in the Ukraine. We have nonstop economic events all day long. One of the good things we could say at this point is that the market's doing what it's supposed to do, what we expected it to do. But at some point, that expectation is going to run out, and we're all going to be wondering what next. Be very careful today with these additional auctions at 11:30. They have been known to completely shift the market sentiment on the day. If we're range bound, these can break us into a trend. If we've been trending, it can flip the trend over. So pay particular attention at 11:30. All right, so we gapped down Sunday night at the open, and right now it is attempting to close this gap. That's a very normal situation. Markets want to close the gap. Think of it like a liquidity vacuum, and it's trying to get back to where it was. We're getting a little bit of a breakout on this wedge, so maybe it's going to give up and not make it there. At some point, obviously, the gap will be filled, but how long is it going to take, right? So if you kind of look back between Friday and Sunday last week, gapped down, came back up, filled the gap, and then continued in that bearish nature. So same thing all over again, just a bigger gap. We're going to expect to close that gap first before we do anything else. Now, there's always this discussion about what we expect the market to do versus what we actually get. Depending on that expectation, how big it is, how common and normal it is, if it doesn't do what it's supposed to do, we start talking about traders getting caught off sides. And this is where you often hear on Bloomberg where they start using phrases like, well, we know what the job numbers are going to be. We know what's going to happen if these numbers are bad. No, they don't. No, they don't. And the more that they use that kind of language, the more I start thinking about if they're wrong, what would it look like? What would the trade be? What's my opportunity going to be? And they get it wrong. Not Bloomberg, they, those, them, the institutions, the money managers, the people that they survey asking about the job numbers, the aggregate reports that come out when they're all thinking about what the impact is going to be due to whatever report. So our expectation right now is that we're going to close the gap. That does mean we're moving up, but that does not mean we're bullish. It's important enough to say that again. We are expecting price to continue to go up to close this gap, but that does not mean we're bullish. We set records on Thursday and Friday for that move to the upside. And there's another phrase for this. It's called a gamma squeeze. When the market makers are forced to buy stock, it squeezes. And of course, this is the ES. So if you're thinking, wait, well, that doesn't really make sense because this is the ES. Yeah, but SPY is the most heavily traded product. So if the institutions and money managers and market managers, market makers are forced to buy stock, they're going to hedge against that stock and they're going to use the ES futures. It's got a hard delta. Options don't have a hard delta, they have a soft delta. So if you want a hard delta, you could trade stock, but that doesn't really get you anywhere, or you could trade a leveraged product like the ES. They were forced into buying the futures because they needed to hedge. They needed to get to delta neutral. And that was across the board. So think of it like a squeeze that happened to GameStop and AMC. It's the same conversation, right? It's the same concept. So don't mistake this bullish rip in the last 2 days as a market reversal. A lot of the signs are there that make us think it is. The 10-year and the 2-year kind of faded off a bit. The VIX was off a ways. We had a lot of volume and a large capitulation candle to the downside. Like we got all the boxes checked. There's just something a little off. We come out to the larger time frame. Always want to just take a peek out there, look around, see if there's anything that we're going to hit, anything of importance. We have the weekly expected move. We already hit the bottom of the weekly expected move and are pulling back up off of it. So we've already made the entire move for the week this morning. Our expectation is that we're going to close the gap, and that'll very likely be all of the move. And we'll just stay range bound between our lowest point and our highest point. We always want to talk about the other side. If that's our expectation, and if that's everybody's expectation, because that's what the market generally does, what if we don't do that? So thesis A would be we're going to close the gap and stay range bound for the rest of the day. That's very likely going to be the day. On the other hand, if it doesn't do that, then what is it going to do? Two other things it could do is close the gap and continue to rip. This 2-day rip could continue. or it could break out of this rising wedge and head to the downside. We do have a head and shoulders, an inverse head and shoulders forming. Depending on how far of a time frame you want to look at, there's your left shoulder, the head, and the right shoulder. On the other hand, there's a left shoulder, a head, and now a right shoulder, right? So, those patterns only get you so far. The cog lines have been really beneficial. I would definitely recommend that you keep your eye on those. For the NASDAQ, same thing on a bigger picture. We've got an inverse head and shoulders. If you only look at the last 26, last 3 days into this section here, then we've got left shoulder, head, and right shoulder for a regular head and shoulders to the downside. So it really just depends on how much data you're using, right? And turning off data never seems like a good idea. The gap is more narrow here. Percentage wise, they're about the same, but we're closer to filling the gap on the NASDAQ. And again, if that's our expectation, if that's what we expect it to do, close the gap and remain sideways, kind of inside this area here, then we want to start thinking about the alternative. If it doesn't do this, then what's going to happen after that? What's the other thing that it could do? And by gaming that out in advance, you've already got your expectation of what you expect it to do. When it starts to deviate from that, you've already got a plan in place for how to trade it. So you can see we're back inside the box. The little box that I just drew probably makes a lot more sense now when you look at it with these. So in green, we've got volume, in blue, we've got time. The red line on those are perfectly matched. That's not always the case, but the red line is the point of control. It's where the most volume was traded in green or where the most time was spent in blue. It makes sense that where we spent the most time is also where we had the most volume, but that's not always the case, which is why we look at both of these together. Right? There's times where we dip down into a low and we have a very small amount of time spent there, but we will find a large pocket of volume there. Right? And so that's beneficial to look at them at the same time. This is a 10-day, 30-minute chart, right? So it's not on a day-to-day basis per se, but it takes a little while to get used to this, because if you look at it today and you think, well, say we were looking at it Wednesday into Thursday, we were outside of the box, but we weren't necessarily, right? Because this isn't the box that we had Wednesday and Thursday. It's the box that we have this morning. Through today, we could look for the market to continue its move up towards the top of the box, or at least towards the point of control, which is really close to where we closed yesterday. But this box won't be in this location tomorrow. So you can't kind of game ahead and think, all right, well, maybe by the end of the day, we're back to the top of the box and we get out, or the bottom of the box and we get out, and that we would game it through the week that way. Because tomorrow, all of this will be in a different location. The box will be recentered. And it does that because this is a 10-day. This indicator is reading back all 10 days. This last day will drop off tonight, and then this will be the last day, right? And so everything will shift. The easiest way that I could explain it is if you took a picture today of what this looks like, and then you take a picture tomorrow, same time. around 6:30, 6:45 of what this looks like. You'll notice that these lines, the value area lines, the point of control, they're no longer in the same spot, and that we may or may not be in the box of that new box, not this box. And I'm mentioning this because somebody had talked to me over the weekend about how this was really messing them up, right? You can't do analysis on this for Tuesday, Wednesday, Thursday, Friday of where these lines are right now and thinking about how far the market could move midweek and would we still be in the box. It doesn't work that way. The box will be in a new spot. You could also use the um, go back 1 month and then go forward day by day by day. Just take pictures of it every day at the same time using the go back, and you'll understand better of what I'm talking about. So here, for an example, this is a day by day. And one of the things that we want to be looking at and why I brought it up is we carry forward yesterday's value area high, value area low, and the point of control. The point of control is the most important one if you don't want a bunch of lines. You really want to know where was Friday's point of control? Because when we get there, we're going to expect a reaction out of the market. 14,125 is close enough. So it's the next quarter. Definitely keep your eye on that. If we happen to get that far up, we have an expectation of a market reaction against that. And it's going to start to become gravity if we get too close to it. So that's a virgin point of control. It's the only one we've got, unless you want to count this one down here. And we're not headed in that direction. But you would continue to plot that point of control forward uh, because it is a virgin point of control. We haven't gone back and tested it or wiped out the liquidity of it. It kind of takes us down into a whole different style of analysis. So we're looking here at the VIX futures. Generally, we don't carry that many curves. Just kind of bump a couple of those off. August or July is fine. What we're trying to identify here is, are we in contango or are we in backwardation? Contango is normalcy. It's what we expect to see, that things close to us in time are cheaper than things far away in time. Generally speaking, there's so many more unknowns in the future that we have to worry about than what's directly in front of us. So normally things farther out are more expensive, and that's called contango. When we're not in contango, when things in the immediate time span are more expensive than things farther out in time, they call that backwardation. We are in full on backwardation here. And the curve is getting a little steeper. This affects everything. Like I was mentioning with the futures ripping up off of the downside from hedging, these are also hedged, right? The VIX futures is what people use to hedge a lot of things, right? And not just people, the algos, they'll just come in and just trade into these. So options in SPY, options in all the big name mega market caps, the FANG names, all of them are going to be affected by this skew. And again, just like last week, if you are going to be day trading options in SPY, the Qs, basically anything, if you're going to be day trading another rip to the upside, do it in a spread so you don't take that volatility crush. If you're going to trade it to the downside with puts, you don't need the spread, right? Because the puts will make money as volatility expands, and they'll make money the more we fall, right? So it's kind of a win-win on the put side. It'll be just the call side that you really need to do the spread on for a day trade in the options. It's worth noting, it's worth going out to the bigger time frame, something like a 1 hour, and just take a look and realize we're back in that same zone, that same area, right? So, when the market does the same thing that it's done before, then we get that complacency and then the normalcy of, oh yeah, we've been here before. No worries. We are expecting to, kind of ping pong through this. So back up to the previous levels through the week. The main thing for today is going to be closing this gap and then seeing it hold the line and not drop back down below 13,500. I've had to adjust the grid in the last few days to bring in products that I don't normally watch on my grid as often. I usually just keep them in a watch list instead, but in the current conditions, they warranted being in the grid. Bitcoin. I don't really give a damn about Bitcoin one way or the other. The reason it's in here is because it's the new hedge, or it's supposed to be, or it may be. They honestly don't know. And if they don't know, how are we going to know? We don't know, right? So with the way that the gold futures were bid up, the way silver was bid up, there's this big economic nerdy argument about how much Bitcoin is going to be able to do and take the place of those old school legacy market turmoil products. So it's on the list. Took a heck of a beat down, but it's recovering just like the others. A lot of that is algorithmic, by the way. It's just the machine doing its job. There's arbitrage as well. And then, of course, I do have gold on here, and it is fading out, gapped to the upside, just like we expected. Notice, after I just mentioned all that about Bitcoin, that Bitcoin reacted like stock. Bitcoin did not react like gold, right? So, important piece to everything right there. Bonds popped to the upside, just like we would expect. And I'm kind of glad to see that they actually did do what we expected it to do, because lately they haven't been. Oil also popped to the upside. Oil and the bonds and the dollar and the VIX, pretty much all holding that same pop and range. You really want to keep your eye on the bonds today. Uh, the Nasdaq got hit way harder in the drop than the S&P did, and now they're very close to the same, near 1% each, and that's what we expect, right? Their price ratio isn't the point; it's the percentage that we really want to focus on. They're equally down near 1%. Very, very correlated state at this market at this point in time. This may be a day for the alpha protocol, right? I mentioned that last week. It's where you run a blanket buy program across the board, because if 92, 93, 95 out of 100 stocks are all doing exactly what the S&P is doing or the Nasdaq is doing, then you don't have to randomly try to run scanners and pick one or two names out of the list. Trade everything on the list. Trade everything. Every single name on the list. Yeah. Highly correlated state this morning. For the dollar, it is starting to wake up and move around a little bit. Keep your eye on this. We want to see if it's going to impact the market. And I say it exactly the way I meant to say it. We want to see its impact in the market today. It doesn't always impact us, right? Right now, it's making moves that the VIX is not. So it's starting to decouple from the VIX. That's a really good thing. You got to keep your eye on this. Make sure it does not begin to sync up with the VIX again. It's also not synced up with the bonds per se. So the dollar is making moves this morning all on its own. It's decoupled. We got to keep our eye on that and make sure that when it does make an exaggerated move like this, that we don't see a hard, sharp, immediate change in market sentiment in stocks, oil, gold, Bitcoin. So when we park our mouse in one spot and we look at everything, oil got hit when that dollar made that move. The bonds popped to the upside, right? Nope. The bonds were late to respond, but they did pop up a little bit afterwards, almost a delayed reaction. Interesting enough, gold didn't really respond the way we would have expected to. The big difference between the S&P and the Nasdaq is that the Nasdaq 100 doesn't have financials in it. So when we start to see these moves in the dollar and in the bonds, it's going to hit the ES because of the banks, and it's going to hit the Nasdaq because of the amount of leverage that those tech companies use, right? They're always going in and getting loans, borrowing money. If the interest rates go up on the money borrowed, the amount of margin profit on the other side goes down considerably. Now the oil's picking up. So that's the grid we're using right now. As you can tell, I don't have the Dow on there, the Dow Jones, and I don't have the Russell. It's not that I'm not watching them. They're just in the watch list, right? I'm a little bit of a quant nerd. I do a lot of market analysis just by looking at sector lists and watch lists, right? I don't need the candles per se. I just need to know the numbers. So it's not that we're not watching them. So we got the S&P 500. We want to set it to pre-market. We don't want 500 names, right? We want to narrow this down to 100 names. It doesn't have to be perfect, and it's hard to get right at 100, so 92 is close enough. It stays gray unless you get above or at 0.5%. So to narrow that down so the color changes actually come into effect sooner, you want to hit the 1x and adjust it from a whole number, which is what we have right now, -3, -2, -1. Adjust it from a whole number to a decimal number. Right now it's a lot more responsive. So you can see that the EV market, or at least Tesla, notice the sector for Tesla. I had quite a discussion over the weekend about this. The sectors that you would think are sleepy, something like consumer durables, it's not so sleepy when you realize you got something like Tesla in there, right? And Tesla is big enough to rock this market. Make no mistake about it. So really want to keep your eye on the sectors and grasp the logic of what is inside each sector. Just your top names, right? Your largest market cap names in each sector. 8 a.m. The dollar opened and the S&P and the Nasdaq just dropped. The S&P dropped 20 points. Yeah, bring it. Let's do this thing. A little bit of mean reversion, it looks like. Take this screen, set it to the NASDAQ 100. I want to hit it to pre-market change percent. Again, we just want to change the color scheme. And it's not necessarily that we're looking at one name, right? We're not hunting for a tradable stock at this point. We're getting a grasp of what's going on in the overall marketplace. Just like with that grid that we were looking at, we want to see the whole of the market. It doesn't matter if I'm trying to trade X Steel or Facebook or, it doesn't matter what you're trying to trade. That one company that you're trading isn't going to move in isolation. It's going to be affected by all of this. Unless it's something like an earnings event or a particular news event, right? Like when Boeing had airplanes falling out of the sky and was killing entire families of people, it didn't move the way that the rest of the market was moving, right? It wasn't correlated with the S&P or anything else. So we are in extended hours. We are looking at the morning, and we want to ask how many names in the S&P are down at least 0.5%. That's like the starting spot, right? If it's down in the pre-market, how much? If it's not down at least a 0.5%, then it's negligible. It doesn't even register. It doesn't matter. A 0.5% is a good starting place. 60% of the S&P is down this morning by a 0.5%. That's not bad. But let's take it a step farther. How many are down at least 1% this morning? 40. That's a significant amount of the marketplace, right? When we're looking around in there, we want to see if there's anything that really stands out. Now, since this is the greater side of the scheme, it's worth asking the question, how many are up this morning? A 0.5%. 4. And they're war names, right? Lockheed Martin, General Dynamics, and Raytheon. Sure, you got a little bit of energy in there too, and it's worth definitely checking out the one energy name that's in there. Take it over to the NASDAQ, run the same screen. How many names in the NASDAQ are up? 2, and one of them is an EV market, Lucid. Now, they had some negative press last week, and this move this morning could be directly connected to that. Either way, linear regression kind of demands that we come back the other direction, right? Reversion to the mean. You can grasp that logic if you look at the ES and the NASDAQ right this moment. We dropped really far in one direction, and now we are reverting to the mean. We're pulling back to where we came from. Not because we're suddenly bullish or because we think it's going to reciprocate all the way back up, but because just like a pendulum swing, you get the movement in each direction. And thank you, Iron. And Lucid had earnings, right? Which we were going to get to if we'd have got to the chart, but now we don't need to. Appreciate it, buddy. So that's the positive side of the NASDAQ. What's the negative side, right? Just take it to the extreme. How many names are down in the NASDAQ? At least 1%, 30. Now that's not bad, right? Comparatively speaking, compared to the S&P, that's not bad. Why is it not as bad? Well, there's no financial names in the NASDAQ 100. Notice I keep specifying that the NASDAQ 100 does not have financial names, right? Don't make the mistake of thinking that the NASDAQ doesn't have financials. That's two different things. And then when it does come to financials, if you look at something like fintech, right? A lot of your credit card companies aren't registered as financial per se, they're IT services. It's a different category. How many names in the NASDAQ are down at least a 0.5%? 43. So if 40 names are down 1%, then only 3 more names are added to that, right? For it to be 0.5%. We're still using the January list. This is from the CBOE website where we went and got the most liquid names that were traded in January and built our list from that. The Head and Shoulders stands out better here, especially since we have really awesome drawing tools when it comes to trading view. Someday we could have this hope that they would update Thinkorswim and really improve its drawing tools someday, right? I think that's one of the big things that Thinkorswim could really use an upgrade on. So it's a little bit squished just because of that right shoulder and the speed of the drop. But if I If I zoom it out, the way Head and Shoulders works, if you zoom into Head and Shoulders, they almost disappear, right? It's one of those things where uh, only the broad outline really works. I'm just going to match that low so that it actually keeps its shape. So there's your inverse Head and Shoulders. The way that we measure an inverse Head and Shoulders, or just a Head and Shoulders, take it from the neckline to the head. That measurement plotted to the upside is your target. On Thinkorswim, we have this new drawing tool down here, quadrant lines. I love this thing. It makes things so much easier, especially when you want to just plot the range. So for an example, back here, we had the range. You just plot the range. Of course, you got to go the right direction. You get 100% and 50%. You put whatever lines you want in there, right? But it plots those lines for you. When it comes to plotting patterns, there's two schools of thought: that the market owes you 50% of the measurement, or that the market owes you 100% of the measurement. I don't want to say that we should only do one or we should only do the other. I would argue that mark them both. And that way, call one, target one, and the other one could be target two. Notice that they line up with other pivot points. It's supposed to. If you draw something and it lines up with nothing, it kind of makes you second guess if you drew it in the right spot, right? But oddly and weirdly enough, when you draw fibs and you draw things like this, and you're monitoring and measuring price patterns, your lines should line up with other important pivot points. And if it doesn't, maybe check to make sure you did it right. Right? We all get it wrong. So our upside target for this inverse Head and Shoulders is 14,600. That's target one. And then 15,1 would be target two. Target two is 100% of the move. I know it says 200 up there, but 100% is our starting place, right? We went from 0 to 100. That's our measurement. If we plot that up, then 200 is our 1%, one move, right? I need a better way of saying that. For those of you that are trading on Thinkorswim as a day trade and you're trying to develop your risk to reward, a little tip since we're talking drawing tools. I never use this Fibonacci extensions tool because I have my extensions already placed in the retracements tool. So if you're not using this, think about using that for your risk to reward formula. All you have to do is snap it somewhere and then go in and edit all of the columns until it has what you want on it, right? And then save that so that you always have it. So then when you go to use it, suppose I wanted to go long off of the lows down here. And my expectation would be that I'm going to run it back up to the highs. And I want to know, is my risk to reward going to work for this? So we can use the quadrant line or the extensions. See if I drew that right. If that's the move we're expecting to see 100%, then there's half. And there's 100% of the move. And there's 100% of the move. Or taking it smaller, since the futures are so big, say I wanted to get in right now and I want my stop underneath this wick. This is, I use a static stop, but this is more of a dynamic stop. Kind of asking the question, if I wanted my stop underneath that wick, how far away is it? And what would my risk to reward need to be? What's my upside target to hit 100% if I use a stop that big? That's my upside target. So a 1-to-1 move would get me back to the top of the box. A 2-to-1 move would get me way up here. That way you can better answer the question, how big of a stop is this going to require and what's my risk to reward going to be for at least a 2 to 1, so that we can answer the question, should I even take this trade? Well, if I want a 2 to 1 trade, I don't have a clear path to get to 2 to 1, because before I could hit that number up there, I've got all of this in the way. So it basically says stand aside. You can't take this trade unless you're willing to use a smaller stop so that you can have a smaller target. All right, so a quick look at the sectors. There was quite a few articles over the weekend about double and triple leveraged products. Hey, guys, remember that those things are designed to be day traded only. You don't want to swing trade double and triple leveraged products. It gets rebalanced every night, right? So you just definitely don't want to swing them. But as for day trade products, they are really liquid and they move, right? They were designed for accounts that can't do options or for traders who don't understand options, but they've been hijacked and they do have options. A lot of them have weekly options. They're super liquid, right? So if you're going to be playing around in the double and triple leveraged products, just remember, don't swing trade them. Get the heck out of them by the end of the day. So as we would expect, gold, silver, bonds, oil, these are the things that are up this morning in the pre-market. We're kind of flat on a lot of names at the moment. IGM, this is that expanded technology ETF. The marijuana sector just slightly down. Energy starting to roll over a little bit, looks like. But these old school legacy S&P sectors miss the point, right? Because there's not an S&P crypto sector ETF that we could use. So we have to kind of make our own. Looking at that list, a lot of these names are down. Basically all of them, right? So crypto's down, not a surprise. Looking at the EV market, we were already talking about Lucid, but we've also got NIO and Tesla, Ride, a couple of the legacy names like Ford and GM, those are down. XPEV is down. And so it kind of a mixed bag. Marijuana sector also mostly down. Getting a little bit of a rebalance, it looks like. Now, I mentioned it before. On days like this, when we can't run the sectors for our stock selection, we can still go in and run our own watch lists. These two watch lists are really one watch list. It's all of the names on the Thinkorswim that have weekly options. But that's a very broad list. It was so big that TrendSpider wouldn't let me make just one list. I had to make two. So I just split the list somewhere near the middle, and now we have two lists. You can see there are plenty of names this morning that are up in the pre-market. There are a lot of things if you just want to stay long, right? And I get it. I would much rather trade long than short. Uh, so if you're looking to day trade long, we have a lot of choices, right? Plenty of names on the list to focus on. And we want to narrow that down a little bit. Instead of looking at 600 names, because that's basically how many names have weekly options. And keep in mind, just because they're designated with weekly options doesn't mean they're actually liquid. Plus, the spread right now, the bid ask spread, just horrible in a lot of names. And there's really no liquidity. If you looked around last week, Nothing was being traded. It was all in the SPY. You know what I mean? Like everything was in there. Look at the millions of contracts that were traded. 43 million contracts traded Friday, and out of that, nearly a third was all S&P products. That's nuts. So we made a shorter list, right? This is the list we got from the CBOE, the January list. Plenty of names in there that are on it to the upside. So as we get closer to the open, guys, remember the correlation that we were talking about earlier. The correlation that states we're running at like an 85 or 90% correlation. You don't have to go in and pick one or two names on the list. You can run something like the alpha protocols that we were talking about and take everything on the list, right? You would go in and buy, say, a 45 to 55 strike option on every single name in the list. Now, my protocol list doesn't necessarily need to be your list. There could be names on here that you think are too expensive. Maybe some name on here you have a grudge with and you just don't want to trade it. Make your own list. When we're looking at a correlated market state, when 9 out of 10 names are all doing exactly the same thing, you don't have to try to go in and pick one name and hope you get it right. This is the advancing issues in the S&P Friday. It's the S&P 500. There's only 500 companies. 489 of them were all advancing. You see my point? So you don't have to try to go in as a day trader on a day like this in a highly correlated market state and pick one name on the list. Pick them all, especially if you're running something like a 45 Delta. Uh, they're not overly expensive. You get to choose the names on the list. This here is the NASDAQ 100. Again, 100 names. And as we were trading through the day on Friday, we were running at 90 names. 90 names were advancing through the day. So if we keep this highly correlated state through the morning, that's what we're going to be focused on, running the protocol program. And keep your eye on that gap close. That's what I got, guys. I will see you all in the futures room. It's my day to stream. Uh, fire up around 9:15 or so. I believe we're going to talk about how you can reset your live account. It sounds good, doesn't it? This is something I've been putting together for newer traders with small accounts in the futures, a way that you can transition from paper to live. And if you blow your live account up, I'm going to show you how to reset it, how to refund it. So if that sounds good, then don't miss it.